Every investor wants a 10x return, and almost nobody understands where these actually come from. Because 10x returns don't come from buying what's already working. They come from buying what can't work yet. And there is probably no one alive who has done this better in the silver and resource space than Eric Sprott. Don't know who Eric Sprott is? And you invest in silver. It's kind of like playing basketball and not knowing who Michael Jordan is. I mean, you can do it, and you're obviously doing it wrong. But to do it right, you need to learn from the best to ever do it. Copy the moves. Make them your own. And today, we learn, so tomorrow, we too can dominate. So, this is the playbook. Not theory, not motivation. This is how capital actually gets deployed at the highest level in the junior mining world. So, get your notebooks ready. Here we go. Step 1. Go to where capital does not exist. Sprott does not start with great companies. He starts with broken ones. Undervalued assets, underfunded management teams, projects that are one financing away from disappearing. Why? Because price is set at the margin. And when there is no capital, there is no competition. This is the first inversion most people miss. Retail looks for quality, but Sprott looks for optionality. Because a company with a struggling asset and no funding can become a completely different company with one check. Which brings us to step 2. Negotiate the deal. Don't accept the market. When you buy a stock on the open market, you accept the price. Sprott never does that. He participates in private placements. That means he gets shares at a discount. He gets warrants, and that's the real weapon. And he often gets influence. So this is not investing, this is structured finance. And let's talk about warrants, because this is where the entire game changes. A warrant gives you the right to buy shares at a fixed price in the future. So if the stock doubles, your warrant doesn't double. It can go up 5x, 10x, even more. And that is how you create asymmetry. Retail buys upside. Sprott engineers it. So that brings us to step 3. Size the bet when it matters. Sprott doesn't spray capital randomly. He concentrates, but only when the setup is right. This usually looks like a depressed sentiment, a proven geology, so not speculation, but not fully valued, and a clear catalyst, so drilling, permitting, financing. And then he goes in with size, so not 1% positions, but meaningful ownership. Because if you're right, you don't need 50 positions, you just need a few that work. Step 4, create reflexivity. And this is what most people never see. When Eric Sprott invests in a junior miner, something happens. Other investors notice. Retail follows. Funds take a second look. Management suddenly has credibility. Capital becomes easier to raise. The stock moves. And that movement validates the original thesis. This is reflexivity. Not just riding the wave, creating it. In other words, Sprott is not just investing in the company. He's investing in the reaction to his investment, which brings us to step 5. Let the narrative catch up. At this point, the fundamentals may not have fully changed, but perception has. Now you start to see interviews, newsletter coverage, YouTube videos, increased liquidity, and this is where people like David Morgan enter the ecosystem. Narrative builds, attention folds, and attention is capital, which brings us to step 6. Use time as leverage. Most people think leverage is debt. In this world, leverage is time. Sprott enters early, before the story is obvious, before the catalysts fully play out. And then he waits, not passively, but with positioning that benefits from every incremental improvement in the story. Drill results improve, the stock moves. Silver prices rise, stock accelerates. New financing causes validation, and each step compounds. So now on to step 7. Exit into strength, not weakness. This is where amateurs fail. They fall in love with the story, they anchor to the narrative, and they think if it's going up, it must keep going. But professionals think differently. They ask, who am I selling to? I'll say that again. Who am I selling to? And the answer is the next wave. This is exactly where someone like Rick Rule has talked about for decades. You sell when liquidity appears, when demand is highest, when the story feels safest, because that is when risk is actually the greatest. Which brings us to step 8, recycle capital. And this is the final piece. Sprott doesn't just make one great investment. He runs a cycle. Enter early, structure the deal, let reflexivity build, exit into strength, reallocate into the next opportunity, over and over again. This is not passive investing. This is capital rotation at the highest level. So here's what this means for you. Now, here's an uncomfortable truth. You can't replicate this perfectly, but you don't have deal flow, access to private placements, and the ability to move markets yet. But that doesn't mean you're powerless. It means you need to adapt the playbook. And so, if you want to learn more about this, the iBankerU version of the Sprott strategy is this. Number 1, follow the footprints. So when Eric Sprott takes a position, it's public, study it. So don't blindly follow, but understand why that company, why now. Step 2, focus on small cap asymmetry. The biggest returns are not in large miners, ETFs like iShares Silver Trust or SLV. They're in companies nobody is talking about yet. And so look for catalysts. No catalyst means no movement. You need drill results, production ramp, financing events, something that changes perception. Step 4, understand dilution versus upside. Junior miners dilute. That's part of the game. The question is not, is there dilution? It's, is the dilution creating something more valuable? So step 5, don't marry the story. And this is critical. You are not investing in a company. You are investing in a phase, and phases end. And so the biggest mistake you can make is trying to be early without understanding why you're early. Early without insight is just wrong. And Sprott is early with information, structure, and influence. You need at least one of those, preferably understanding. So here's the final insight. The reason Eric Sprott can generally is not because he's predicting silver prices better than everyone else. It's because he's operating in a part of the market where small changes in perception create massive changes in valuation. And that's the game. Not silver, not commodities, perception. And once you see that, you stop chasing price and you start positioning for revaluation. And now you know the rest of the story for how people like Eric Sprott get 10x returns. Build that stack. iBankerU. Good day.